Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. And with May 17th, this year's tax deadline right around the corner, let's talk today about how you can make your investment portfolio more tax efficient. The great investment fund manager John Templeton once said that all investors have the same objective: maximum total return after inflation and taxes. Okay. Now, why did he throw taxes in there? Because I can tell you from having been in the money management business for many years that most people are seemingly oblivious to the tax liabilities and ramifications of what they're doing in their portfolios, and it costs them a lot of money when taxes are due. And oftentimes it's because people think, well, what can I do? Taxes are the price we pay for a civilized society, and there's no getting out of them. Well, you do have to pay every bit that you're legally obligated to pay, but you don't have to pay one penny more, and there are ways to keep your obligations as low as possible. So let's talk about what those things are. The first thing you want to do is not own actively managed funds, because actively managed funds by law have to distribute over 90% of their realized capital gains. So even if you're a buy and hold investor and they've taken lots of profits during the year, they'll distribute those profits to you in the form of capital gains distributions. And then the IRS but demands that you pay taxes on those. So don't own actively managed funds. Most of them underperform their benchmark anyway. 3 out of 4 of them every year, more than 90% of them over a period of a decade or more. So index funds are preferable to actively managed funds. When you own an individual stock, you can control the tax liability because you don't owe a capital gains tax until you sell. In fact, Warren Buffett once famously said that the capital gains tax is not a tax on capital gains, it's a tax on transactions, meaning that if you don't sell a stock or any other asset for that matter, you don't own any tax on it. And that's why he says that his favorite holding period is forever, because he would prefer to be untaxed. When you do sell, the IRS allows you to offset your realized gains, those are gains you've already taken, with realized losses. So at the end of each year, you should look at your portfolio, and if you have a lot of realized gains, sell some things that are down. After 30 days, you're allowed to buy them back. If you don't wait 30 days, you're gonna actually still owe the capital gains tax. It's called the wash sale rule. So you have to wait 30 days, then you can buy something back. But you want to realize your capital losses against capital gains. And there's another thing it's really important that people seldom think about, and that is some assets, some investments are simply tax inefficient. For instance, a high yield bond, you're going to owe tax at your income tax rate on all those interest payments. So anything that's high yielding or tax inefficient should be in your qualified retirement plan. I'm talking about your IRA, your Roth, your 401k. It's all compounding tax deferred. And then in your non-tax deferred accounts, if you're not turning things over, holding stocks and holding index funds, there's simply nothing there for the IRS to take. So as a result, you're earning a higher return, a higher real world after tax return, because you're not surrendering as much to the IRS every year. I actually have a chapter in my new book, The Gone Fishing Portfolio, about how to legally stiff arm the IRS. None of this is the least bit questionable. This is just using the laws as they're set up. And so I encourage you, if you haven't read that book, to check it out, but also to be very sensitive to the tax implications of what you're doing in your portfolio. That's it for today, but I have lots of other commentary on other topics that you're welcome to listen to. Either here on this channel, you can subscribe by clicking on the button below, or you can subscribe to my free e-letter, Liberty Through Wealth. And that's it for today, but thanks so much, Alexander Green. Look forward to talking to you again soon.